The company being analyzed today is SRM Contractors Limited. This is a construction company which constructs roads, bridges, and other things like tunnels. So today we're going to analyze the company's financials, what it actually does, and its future growth outlook. This is a company which is aiming to grow extremely fast. So let us start. First, we have the market cap of 1,316 CR, small cap company. Price of one share 574. Book value, that is net asset value per share, is 116. A nice return equity 25.6%. Nice return capital employed way over 20%, 31% right here. And the price to earnings ratio is 22.4. So nice ROE and ROCE. Moving on to the profit and the loss statement. From 2020 all the way to 2025, we have sales, we have operating profit, we got operating profit margin, operating profit and EBITDA is same thing, profit before tax and net profit. So in 2020, the company reported sales of 87 CR, then massive growth, 2022, 264 CR. Then growth slowed down a bit, 300 CR, 342 CR. The operating profit rose from 30 CR to 42 CR. So big growth in operating profit. Finally, in fiscal year 2025, the company reported sales of 527 CR, 81 CR in operating profit, an operating profit margin of 15%, profit before tax of 67 CR, and finally, profit after tax of 50 crores. All right. In percentages terms, look at this. The CAGR for sales growth has been 43% over the last 5 years, 26% over last 3 years, and TTM is trailing 12 months, previous 12 months, 73%. Similarly, last 5 years, the profit growth has been 69% compounded, last 3 years, 40%, and TTM trailing 12 months, last 12 months, 148%. Stock prices also moving around 118% in 1 year. Then return equity has seen a slight decline. So this is something to be kept an eye on in the future, if this will decline or not. But 5 years ago, 29%, 3 years ago, 27%, last year, 26%. Now, high growth company, profitable company, what does it actually do? So SRM Contractors building the backbone of India's toughest terrains. Okay, so we got four business segments key. Three actually, sorry, three. We got roads and bridges, we got tunnels, and then we got slope stabilization, which is literally, as it says, stabilizing the slope. Okay, so slopy, hilly regions. All right, you see the growth percentages for revenues, EBITDA, and profit margins, massive. And as of August 2025, it has an order book of 1,476 crores. So revenues of 500 something crores and orders it has got from its customers, that is the order book, is 1,476 crores. Earlier, we did not also have the EBITDA margin. So EBITDA margins also grew faster than revenue. So company grew more profitable. All right. And executed critical tunnels in high altitude Himalayan terrain, built major bridges and roads across remote border regions. So these hilly regions, regions with difficult terrains, remote border regions, focus of the company is on those locations. Then moving on, resilient business model. In this, pay attention to these black lines. 60% of the order book contains road and bridge projects. So going forward, major part of revenue will come from road and bridge segment. Then 11% comes from tunnel projects. So smaller portion of revenue going forward in the future will be coming from tunnels, and 29% of the current order book, 1,470 something crores, will come from slope stabilization. And if you're wondering what is slope stabilization, the slope stabilization division designs and builds reinforced soil slopes to improve stability and safeguard infrastructure. So they literally design and build reinforced, so man-made soil slopes. Okay. So road and bridges is the major thing to keep an eye on. Moving on, investment thesis, critical backward integration. Okay, critical backward integration of the company. The company in its entire supply chain is backward integrated. So coming from the back supply chain, that is raw material acquisition, it's present there. So one, it manages and owns its construction equipment in-house. In-house capabilities. Let me zoom in. 300 machines, including 100 plus key assets like boomers, batching plants, hot mix units, ready mix concretes, etc. So a lot of equipment it has on its own. It manages on its own. It owns them. And self-reliant model, it minimizes reliance on third-party contractors and vendors, strengthens coordination across sites, and enables faster construction. It's a self-reliant model. Then centralized EMS, equipment managing system. So it has a centralized procurement and equipment management system. So it's backward integrated, meaning it's relying less on third party vendors and a lot of its equipment is its own. Okay, allowing for faster acquisition. Then moving on, investment thesis number two. First was backward integration, second was expertise in challenging geographies. Now, 17 plus years in Jammu and Kashmir and Ladakh, specializing in complex hilly infrastructure. Then look at this. It's established itself as a regional leader in Jammu and Kashmir and Ladakh region, and it's expanding footprint into other difficulty hilly regions across India. So the companies, the company is a key player or a leading player in Jammu and Kashmir and Ladakh region, which are very important for the company's revenues and growth. So Jammu Kashmir and Ladakh, key regions, then focus on hilly regions, focus on regions with difficult terrains. That is another focus of the company, which may differentiate from other construction players. Moving on, the guidance. Okay, important. Growth outlook in fiscal year 2026, they're expecting revenues of 900 crores for fiscal year 2026, fiscal year 2025 was 520 something. So massive growth. And the profit after tax margin, they're deciding for 9%. Okay, this year's was I think 10 point something percent. So 9% plus. An EBITDA margin of 20%. This year was 15 something percent. So massive increase in EBITDA margin, and they're expecting an order inflow, meaning new orders, that is work from customers, around 1000 plus CR for fiscal year 2026. So this is the new orders they're expecting to come in fiscal year 2026. We are currently actually in fiscal year 26. Now, let's go to the balance sheet of the company. Here we will focus on fiscal year 2025 balance sheet. So what can we focus on here? So first of all, what are these numbers in? Are these numbers in CR? Yes, all these numbers are in actually crores, crores of rupees. So first, long-term borrowings, the company has 14 crores of long-term borrowings. All right. It has short-term borrowings of 26 crores. Trade payables, meaning money it has to pay to its suppliers for the raw material it took from its suppliers. So let's focus on short-term borrowings 26 crores, long-term borrowings of 14 crores. All right. Let's move to the assets. What are the assets looking like? Very importantly, 92 crores in cash and cash equivalents. 92 crores in cash and cash equivalents. Previous are the previous 2 years, but this is the recent one. So its cash and cash equivalents it has is more than its long term plus short term borrowings. Short term loans and advances it has given to maybe its subsidiaries, related parties, 91 crores. Okay, so a lot of cash. That's a good thing. That's a good thing. And current investments, meaning investments it can sell and get cash for in the next 12 months, 19.4 crores. So, the balance sheet wise, it looks like a very healthy balance sheet. Moreover, the total current assets, meaning assets which can be liquidated into cash for the next 12 months, are 328 crores. Okay. Of course, it recently had its IPO, so IPO funds are included in this. And current liabilities are only 117.57 crores. So current assets divided by current liabilities, current ratio is, I think, more than 2, almost 3. Moving on, moving on, we move on to other things. It looks like a pretty healthy balance sheet overall speaking. A lot of cash, 90 crores. Cash flow. We got the cash flow from fiscal year 2023 to fiscal year 2025. Focus here on net cash from operating activities. Cash flows are not a strong suit of the company. Only 1 crores cash flow in fiscal 2025. This is also declining figure. 21 crores in fiscal 2023. Net cash from operating activities 14 crores in next year, and this year 1.1 crores. So not the strongest suit for the company, but at least it is positive. That's what we can say. Then the order book. We already saw analysis of order book. The order book amount is 1,470 something crores. So, but 68% is how? 68% is, sorry, 60% is from roads and bridges. 29% slope stabilization, 11% tunnels. Then region wise, Jammu and Kashmir, 36% of this order book. These orders from customers are from Jammu and Kashmir. Then Uttarakhand is 19%, hilly region. Leh is 10%. Gujarat, okay, 17%. So Jammu and Kashmir is a very, very important market. And here you can pause and see the numbers, numbers of this order book, how much orders are coming from which region. Then the average completion time of these orders will be 18-24 months. So average completion time of these construction projects are 18-24 months. Moreover, tenders, meaning it's bidding for more projects, right? It's going to continue bidding for more projects. Tenders under evaluation and in pipeline, meaning bids it is deciding for, and the bids it has already given out, bids for new projects, are 4,000 crores worth of projects it's bidding for, or evaluating to bid for, or very close to bidding for. And tenders in pipeline for HAM projects is 2,157 crores. If you're wondering what is HAM, as a quick summary, HAM stands for hybrid annuity model. For example, you're constructing a road under, let's say, hybrid annuity model. So you pay for a part of the project, but the company you are constructing it for, your client, will not pay the entire cost upfront. They will only pay for some of the cost, and then the remaining part of the cost they will pay in annual payments or semi-annual payments. This project is more financially, what do you say, intensive, financially draining for the company, like constructing. The constructing company, it's more financially draining for them, but but it provides stable cash flows. So it has its trade-offs. It's not necessarily a negative. It has its positives and its negatives compared to traditional models of just building it and the company you're making it for pays for it entirely. That's known as an EPC model. It's also a build, operate, transfer model. But HAM, it has its downsides, it has its upsides. So yes, finally, the last thing, long-term debt of the company. These numbers are in lakhs. Okay. So long-term debt, 14 lakhs in fiscal 25. Nice decline. Short-term debt has seen a bit of a rise from 21 crores in fiscal year 23, 26 crores in fiscal 25. Okay, and 14 crores of long-term debt. Gross debt overall, the total debt has seen a bit of a decrease from 47 crores fiscal 24 to 40 crores in fiscal year 25, and gross debt equity. So comparing debt to equity, debt has gone from 0.74 times of equity to 0.009. Lower is the better. That is a very, really good thing. And it has been given a credit rating of A minus. All right. Anything else? No, I think that is it. So that is it. So as a summary, focus on Leh focus on Jammu Kashmir, the biggest one, Jammu Kashmir. Focus on more hilly regions. The company is focusing on these regions and massive revenue growth prospects because of the massive order book it has 1400 crores, and the orders, the new projects it is bidding for, they're around 4000 crores. It's evaluating these projects. Then backward integrated, it has its own equipment. It relies very less on third party vendors, so the execution of the project, it depends on the company alone. It doesn't have to rely on maybe some other contractors. No, everything it does on its own, or mostly it does on its own. It has seen slightly rising profit margins and is expecting higher profit margins, like EBITDA margins of 15% this fiscal year to now 20% fiscal year 2026. And I think that is it. Finally, cash flow. It's not the company's greatest suit. So that is it. It does have high, decent ROCE actually. ROCE and ROE. Pretty sure there is a stat here showing that. Okay, yeah, I didn't see this. So ROE and return capital employed of the company pre-tax and post-tax, both numbers are given. All right. So in blue, we have the return equity, and in orange, you have the return equity pre-tax. That's how I think return capital employed is calculated. So return on equity was 20% in fiscal year 2025, was 21% in fiscal year 2024, and 39% in fiscal year 2023. So quite a sharp decline in return equity, meaning profits have not grown as fast as the growth in equity. So assets grown way faster, and we saw that the debt actually declined. Yes, one factor is the gross debt declining. So assets minus liabilities is the denominator of return equity. So profits have risen a lot, assets have also risen a lot, but debt has decreased. That is one thing. Then return capital employed 35% declined to what is it? 26%, and right now and 28%. So still speaking, high return equity and high return on capital employed.